It's always easier and quicker to get where you want to go when you're sailing with the wind. And we believe sailing with the wind describes the environment investors are likely to experience as we go into 2024. I'm going to explain exactly what we mean by that in this brief video. I'm Steve Bryce, and I'm Standard Chartered's Global Chief Investment Officer. What do I mean we expect investors to be sailing with the wind as we move into 2024? In 2023, the key concern was that persistent high inflation would cause central banks to continue hiking interest rates. But now, with inflation coming down sharply, the focus is likely to shift to when monetary policies are eased. And this should be a tailwind for investors in early 2024. Let's start with the economic outlook. We expect global growth to slow in 2024. In the US, we expect the pace of growth to fall to less than 1.5% in 2024. That's from around 2.5% in 2023. Meanwhile, Europe is likely to be verging on recession through much of 2024. Even in China, where the government has been propping up the economy through stimulatory policy measures, growth is likely to be sub 5%. This, together with easing supply chains and reduced service sector price pressures, means inflation is likely to continue falling sharply in 2024. What does this mean for monetary policy settings? Quite simply, it's crucial. Central banks are ultimately likely to shift away from worrying about high inflation towards focusing on supporting growth. This is unlikely to be a smooth process, as highlighted by the recent strengthening of the labour market, but the trend looks reasonably clear to me. Against this backdrop, bond yields are likely to go down, which means bond prices will go up, boosting total returns. We have a strong preference for the safer areas of bond markets, especially in developed markets. The growth slowdown should undermine corporate cash flows and, as a result, the riskier areas of the bond market as we go through the year. Our top pick in this space is developed market government bonds, where we see real or after inflation yields as increasingly attractive. The decline in bond yields also has implications for equity markets. Falling inflation is likely to reduce concerns of a hard landing as we enter 2024. That's because it increases the flexibility with which central banks have to respond to signs of weaker growth. Absent a hard landing, this should help equities to perform well in the coming months. Within this, we have an overweight allocation to the US market, which is tilted towards areas of the market that are more resilient to economic weakness and benefit from lower long-term interest rates. This includes the communication services and technology sectors. We're also overweight on Japanese equities, as we believe companies will increase dividend payout ratios and share buybacks, as the focus remains on improving corporate governance. Turning to China, where policy stimulus is likely to give a shot in the arm to the economy in the short term, but longer-term challenges remain. Against this backdrop, we prefer to take a more focused approach, either through sector or stock selection. One thing the China market offers an investor more than most other regions or countries is a structurally high dispersion of stock performance. This means it's relatively easier for stock pickers to outperform the index. From a sector perspective here, we are overweight on the technology, communication services, and the consumer discretionary sectors. Finally, we expect the dollar to be range-bound, with a bearish bias in 2024. Therefore, we would look for any short-term US dollar rallies to sell into, with the Australian dollar and the Japanese yen likely to be the major beneficiaries. Dollar yen is likely to be volatile as markets focus on the potential for further monetary policy tightening in Japan, so investors should avoid using the yen as a funding currency. The last thing I want to emphasize is the importance of understanding and mitigating your own behavioral biases. I know people have been sitting on cash in 2023. This is in part understandable given the high yields on offer. However, it is important to have a plan to increase the level of investments to generate longer-term returns. I hope this video has given you some idea of how you might reposition your portfolio as you move into the new year. If you'd like more information on our investment views, Please download our 2024 Outlook and don't forget to reach out to your relationship manager for a portfolio review to ensure that you're well positioned for the opportunities and risks ahead.